Hello everyone, and welcome to my new video on stock market. In this video, I'm going to give you some genuine advice on how to make money in stock market. These genuine advice are quite simple, but most people do not follow this simple advice. They try to make everything complex, like they make the stock market a bit more complex, and that's why they lose money or do not make good returns in the future. So I will, of course, share some of the genuine advice. Those are quite simple, and you can follow and make money in the share or stock market. And before I go on those advices, please subscribe to my channel and do support me in making further this type of videos here. So this was the post I shared recently on my LinkedIn account. So here it was like why people actually lose money in the stock market. So if you see anyone, they actually when they are trying to buy a car, mobile, or anything, or house, like they do a lot of research in those, like I mean, in which area we should buy a house, which mobile I should buy. But when they are going to buy a stock, they do not do any research on that. So that's where most people actually go wrong. It's not only about directly buying stocks. If they're buying mutual funds also, index funds also, or anything, they do not do any research in this. They just buy it. And if, let's say about a stock itself, they just buy it because it's going up. I mean, price does not make much sense. I mean, you have to consider other things also about the stock, but they just see the price and buy it because everyone else is buying. And but when they lose the money, they blame it on everybody. They do not blame on themselves, but they will blame everything, market, other people, everything, but they will not blame themselves. And now also most people have this misconception that they require a lot of knowledge or something for investing in stocks or investing in stock market, but that's not true. You just require basic maths, which is basically taught in fifth, sixth class mostly, like CAGR calculation, division, multiplication, all this. And you need that much of knowledge for like doing the calculation and everything. And of course, you need English or whatever language. Yeah, that's another thing. You do not need CA, MBA, PhD degree for like investing. All one requires is like basic maths. If you are like if you are studied till class 10th, that's well enough. And also if you see like, I mean, you would have studied tougher subjects than a stock market. Stock market is quite simple. If you have studied your 12th physics, 12th chemistry, 12th maths, or if you have done MBA engineering, those are quite tough, I mean, than the stock market. I mean, studying about stock market and how to learn, I mean, to invest in stock market. This is easier than those things. But people I has a misconception that okay, it will take very a long time to study about all these stocks, so let's leave it. Of course, I have started this YouTube channel here to make people, I will say, easily understand these concepts. Like it's not some, I will say, rocket science to understand stock market, analyze stocks. It's quite simple, not that tough. Now, this is one of the, I will say, very important books I read. That is The Richest Man in Babylon. So, this was mostly about personal finance, but this book did teach me some important lessons. Like I'm sharing the five of them here. Like you should save some percentage of your money. It could be 10%, 20%, 30%, 40%. It depends on you. I mean, how much you want to save. But you need to save some percent of money. Do not spend all the money on, I mean, something. Also, you need to control your expenditures. I mean, you look at your salary and decide that, okay, whether I could afford this or not. Let's say your salary just, let's say 5 lakhs per year. Now you want to buy some car that cost is 30 lakhs. I will say, I will not advise against doing that on loan or something because, okay, if your salary is maybe 30, 40 lakhs, it's okay to buy a 40 lakhs car maybe. But if your salary is say 5, 10 lakhs and going for a 30 lakhs car, does not make sense. I mean, house is different thing, but buying car is different. I mean, here. That's what control your expenditures. I mean, basically, only expense your money on something that's required for you. Also, of course, you are saving, but you should also make this money multiply. It's not that saving means you should keep the money in your house or some piggy bank or somewhere. You should keep somewhere where that money keeps on growing. It can be fixed deposit, stock market, or anything, any investment. Also, this is very important. Avoid get rich quick schemes. I mean, do not try any schemes which are telling you that you will get like you will double your money in 40 days, 21 days, 100 days. Do not believe in this type of schemes. I mean, really, you will lose a lot of money there. Do not follow this. I mean, whoever are telling this. Also, the last one is important. Of course, saving is good, but you also need to increase the savings. Now, how will you increase the savings? You need to improve your ability to earn. You need to, I mean, basically in your job, you need to do good work. You need to be promoted. I mean, you want to be promoted further up, your salary should increase. That's why you basically, again, save more, invest more, earn more. Now, investment in stock markets, I will say, I can categorize mostly through four ways. The fourth part, mostly three ways, but fourth part I have also kept here. So first is, of course, invest directly in stocks, directly buy the stocks and sell those stocks. Second is invest indirectly through active mutual funds. Like active mutual funds are where they are fund managers. You give them their money and they actively select and buy and sell the stocks. Then there is passive investment also, like invest through index fund. So index fund, like the fund managers does not do anything. So index is already there, like Sensex or Nifty. They just buy these index, whatever stocks are there in the index, in that weightage, and that's all. And last one is like if you do not understand any of this, and still you want to invest in stock market, maybe you can provide your money to the professionals, like who are very experienced in this. I will discuss about all of these separately, but first and important, understand the power of compounding. Why you should invest in a stock market? That's important, right? Why you should invest in stock market? Why not in fixed deposit? Why not in real estate? Why not in gold? So let's understand the reason here. Understand the formula for compound interest formula. That is your final amount is equal to your principal into 1 plus like whatever returns you are getting, that is I, and this is power of n, that is n is time. Understand this formula. I mean, look at this formula. Now everything is a, I mean, power of time, right? So what that means is that, see, if let's say this 1 plus I is this, let's say 1 plus I is 2, let's say example it's 2. Now you think like this: 2 power 1 is just 2, 2 power 2 is 4, right? Now but if you go to 2 power 3, it's 8, right? Now again, let's say if you are there, if you are in stock market for one more year, let's say fourth year, now 2 power 4 is how much? 16. You're seeing how it is exponentially increasing, right? This is not linear increase, like 1 is 1 to 1, 2 to 2, 3 to 3. No, this is exponential. Like when time is 1, you are at let's say this 1 plus I is, and total value is 2. Principal I am, let's say principal is just 1. So overall is 2. When power goes to, like time goes to 2, you make it 4. You are getting it, right? When the time, let's say, goes to 10, 2 power 10 is, I mean, huge, right? You're understanding the exponential that is coming. I will show you that with the example here. Better you will understand this. So take example of Nifty 50, which is an Indian index, sorry, Indian stock market index, and see its returns from 1996. So it came into picture from 1996 only. So I'm seeing the returns from there. So this has given 11% CAGR returns in 24 years, including dividends. Now let's say if you are invested, let's say 24 years back, rupees 10,000 in this, maybe in this Nifty 50 index itself, let's say, then the total worth today will be equal to 1.2 lakhs here today for you. That means basically you have multiplied your money 12 times in 24 years. That's quite huge, right? If you see, CAGR is just 11%, but you have multiplied by 24 times your money, so 12 times your money. But take another example. I told you time is important here. What if you invested just for 20 years? What if you sold, I mean, let's say before 4 years? Now your total worth will be only equal to 80K. So that's the power of compounding. You see, from 12x returns, you just went to 8x returns because you just missed the last 4 years. So that's where power of compounding actually comes in. So I mean, more the time you spend in share market, more your returns will be in the future. Okay, this is the warning. Like, okay, now everybody asks like, how, what is the expectation from like you about the share market returns? How much you are expecting from share market, right? Now, I will give you an example here. Okay, no, sorry, this is not about that. So this is about after how much time do you need the money? So you should not blindly invest in a stock market. So you have earned your, I mean, money by doing hard work. It's not that, okay, I should spend in stock market. It's not compulsory. It depends on your risk profile and everything. I will give you some examples. Let's say your time horizon is 5 years. Let's say after 5 years, you need that money back. I mean, you need that money back anyhow, right? You cannot suffer loss or anything. In that case, I will suggest you do not invest in stock market in any way. In 5 year, you may have negative returns also. Like if you invest in, let's say, maybe 2020, and 2025, maybe that your returns are still negative. It may happen, or returns are still less than FD returns. Also, it may happen. So if your aim is just for 5 years, I will say no, do not invest in share markets, or even if you want to invest, maybe 10% maximum. Do not invest much in share market. But if you are going for 5 to 10 years, I will suggest you to maybe you can increase the allocation now in stock market to around 30 to 40% if you are for 5 to 10 years, and the rest of the 60% money you can keep in fixed deposit or other investment or safer investment. But if you are there for 10 plus years, that's where you should be aggressive, because mostly when you are for 10 15 years, mostly you are young, like you will be like in your 30s or 25, like I am 26 now. So for me it makes sense to invest for 10 year 20 years. But if you are, let's say, at maybe at the age of 50, then you will not allocate a lot of part of your money in stock market, of course. Maybe you will do like 30 70 or 20 20 80. But if you are young, at the age of 30 35, around 20 25, then it's better to do it 70 30. Might be like 70% in stock market and 30 in fixed deposit and others. So that's my advice on this. That's what I follow. So for me, I am 26, so I follow this 10 plus years. So 70% mostly I will try to allocate to equity and 30% to other, like FD and all. Now let's look at investing in stock market directly. This is the first one. Of course, the risk is the highest here, and of course, see, understand this. When the risk goes high, there is a chance of high returns also. When the risk goes low, there is always a chance of less returns. In FD, you do not have any risk, almost no risk, so you get 7%. You move a bit higher into a stock market. There you see there you have higher risk, and of course, chance of higher making higher returns. That's why people go for equity investment, because returns are high here. And of course, maximum effort is required in when you are investing in stocks directly. That's where maximum effort will be required. And over long term, 10 plus years, you can earn around, like, I mean, 50 to 20% CAGR over long term. I mean, if people are saying you that you can earn 30%, 40% over 10 plus years, I will say do not believe them. This is the average, as most people get 15 to 20%. If you are doing very good, you make it 25, I mean 30. Even Warren Buffett, if you see, right? I mean, his wealth also has a compounding at around 20%. So that's what you should mostly in the long term you should assume your returns to be. Also, buy good stocks and hold for long term. This should be your, basically, if you want to get this type of returns, that's what you should follow. Now, for if you're investing in stock markets directly, you should have the ability to understand the company, the financials of the company, do the fundamental analysis of the company. You should be able to do all of this. Then only you should invest directly in stocks. Otherwise, do not go for direct stocks. Of course, patience is the key here. You do not require PhD, MBA, or anything. The only thing you require is, like, you should understand the financial numbers, understand the company, and have the patience to hold the stock for 10 15 years. And of course, if you get the dividends on the stock, reinvest it. That's where the maximum growth comes. Keep reinvesting the dividends in the stock again and again. Now, how to research and what to research in a company. This is very important, because you're investing directly. You should do some research. You should not blindly invest in some companies. Now, these are some of the important criteria I follow. How company makes money. What are the products of the company? Like, what are the growth and demands of its products? Whether demands is increasing, decreasing, or what the company is doing to increase the demand. How are the promoters and the management, like what decisions they are taking and how innovative they are. You should look at everything. Then what are the sales and profits of this company from the past, from last 10 years, like how this company has been doing. How is the debt level of the company, like is the company like having high debt level on their book or not. What is the valuation of the company, is the company undervalued, overvalued. You should see all of this. And at last, how good the company is at deploying its capital. So it has money, it is deploying it into the business. Now, how much, I mean, return on capital employed, right? So let's say I'm investing my money in fixed deposit, I am making 7%, let's say. That's my return on investment. Similarly, for a company also, if it is investing its money into something, it should have higher returns there also. So you should look into all of this. Now, how to gain knowledge about stock markets? Like, if you want to invest directly, how you should get knowledge about this? Of course, read books. So I have made a video on like all the books, important books. You can find the link in description and also at the top here. Read articles, watch videos. So watch videos on YouTube, read articles of like many newspapers and on Google also, like you do Google search. And of course, you should not follow this advice blindly, whatever somebody is telling in video or in an article. Do not go and buy that stock. Of course, you should do your own research also, and you can use their points also in that. Google search is of course there. If you need any help with anything, go to Google search. Read annual reports, results of the company, investor presentation, look at this, and also conference call. Like if you're not able to attend the conference call, it's okay. There is the transcript for that on the website, so you can read that after the conference call. And for daily news and everything, you can go to Twitter and follow some of the investors there also. And of course, for news also, Money Control is again for looking at a share price and everything and news. Money Control. Economic Times is again very good for like news related to finance. So I follow all this. Other than that, on Value Picker forum, if you go there, like there are a lot of good investors there. They are providing their view on various stocks. So there also you can do a research. Other than that, follow brands and their management team on Twitter and LinkedIn. So most of the good brands, like let's say Britannia is there, they will be there on the LinkedIn as well as Twitter. So follow their company page, follow their, let's say, if their CEO is there, then follow them also. So do this also, because you know about this company, like their management, everything you come to know from this. Now, okay, let's discuss about stock wealth creators and stock wealth destroyers in last 10 years. Of course, both of these will be there. So if you look at stock wealth creators, like Eicher Motors has given 35% CAGR returns over last 10 years. Understand this. This is not absolute returns. This is compounded returns. That is CAGR returns. Then for Britannia, if you see it's 34%, Pidilite 26%, Asian Paints 21%, HDFC Bank 18%, TCS 18%. So all of these are quite big companies, not small companies I am discussing. These are part of Nifty 50. So that's what returns they have given in past 10 years. But other with this, again, you will have stock wealth destroyers also. These also are big companies and which have given, if you see like, I mean, CAGR itself, but minus 21% CAGR. So from stock price of 50, it has like fallen to 5. Vale has given minus 18% from 300 to 41. Stock price was 300 10 years back, now it's 41. Bank of India minus 18% CAGR from 400 to 49. Similarly, PNB, Punjab National Bank, minus 16% CAGR, 250 to 37 now. So of course you will have both. Now remember this. This is important. Now you will say why I should invest in a stock market when this type of stocks are there. I will give you a reason for this. Now, if you have 10 stocks, of course you should have 10, 15 stocks. It's not you should only have 3 to 4 stocks. If you have 10 stocks, of course 3 to 4 are going to do very good. 2 to 3 are going to do decent, I will say, just some returns like 5, 6%, 7%. 3 to 4 will give you, let's say over 10 years, 15, 20% return. Next 2 to 3 will give you maybe 10%, 6, 7%, 10%. 3, 4 will give you maybe 2%, 1% or negative returns, let's say, right? So basically this will be your portfolio mostly after 10 years. Now, basically the 3 to 4 that very, very good stocks that is giving 50 to 20% will decide all of your earnings basically. Most of those are dependent on that. Because if you can find in 10 years like 2 to 3x bagger stock or 2x bagger stock, then overall your portfolio returns will look good. Now, if you take the example that if you pick 10 stocks and all do bad, then I'm sorry, you're doing something wrong. You should then move back to index fund or mutual funds. If this is the case, now investing through active mutual funds. Like these mutual funds are active. They keep on churning the stocks at different time. Of course, risk is here again because they are investing in stock market. Whenever somebody is investing in stock market, there is risk. Of course, again, risk is the returns also here is high. Like returns, you can expect around 10 to 15% here, and mostly around 10 to 13 or 10 to 12% mostly. But of course, you can expect till 15% also. Of course, less effort here because somebody else is managing your money. Mutual fund managers are managing your money. So less effort from your side, but still, you need to analyze the funds, the mutual funds, because these are active mutual funds. You need to look at some numbers like expense ratio, what portfolio turnover, what is the return in past. Does this mutual fund has beaten the index funds in the last 5 years or not? You should see all of this. And also you should diversify according to your age in all of these stocks. Like if your age is like maybe at 40, 50, you should mostly be going towards, I will say, large cap companies. But if you are very young at 25, 26, then maybe you can be aggressive also in small cap and mid cap also. Investing through index funds, this one is the easiest one, right? This is like passive kind of investing, But risk is again here because index funds are also investing in stock market. The risk here, I will tell you, is Sensex. Take for example Sensex. It's an index. Now it crashed by 60% in 2008 and 40% in 2020. So of course you can see, I mean, this crash are not normal crash, right? So of course risk is here again. Now expected returns, what you should get for index fund is 10 to 12%. But you should remember that 90% of the active mutual funds in India in the last 2 years have not beaten the index funds. That's understand that only 10% of the active mutual funds are able to beat the index fund. So if you do not want to take much risk, I will, and if you are like a simple investor, you just want to get 10 to 12% return. If your expectation is that without taking much risk, go for index funds. That's quite simple for me, and it's very less effort is required because these funds are very passive. I mean, even the fund manager cannot do anything, right? Because stocks are dependent on this index which are managed by like I mean this index are managed by the market capitalization of the company. If the company is bigger, they will be there. If the company falls, they will automatically go out of this index, right? So it's very automatic. I mean, of course, this is the easiest way and beats 90% of the mutual funds and even professionals. I mean, professional like I am picking the stocks. Even this has a chance of like, I mean, 90% there is chance that I would also be able to fail in. I mean, fail in beating these index funds. So that's what powerful these index funds are. Of course, in India there is Nifty 50 index funds and Nifty Next 50 index funds. And if you want to actually pick some of these funds, the index funds, I have made a video on this also. I will paste the link in description and also at the top here. Do watch that video. Of course, the last one is hire a professional. Of course, risk. I mean, risk is again here also because here, I mean, of course, double risk is there because of course they are going to invest in stock market. That's the risk, and you are giving your money to somebody else. Now, if that somebody professional, that is very professional, but if he or she does not do good, there is also again your risk, right? Now, expected returns, of course, you have to pay them, right? They will not do this for free. Even mutual funds, you have to pay them some money, but expected returns after fees should be at least greater than index fund returns. Then only you should hire someone. If they are not giving these returns, I mean, it's better to go for index funds again. And through professional, they can also invest directly in stocks and also in mutual funds. They can use both the ways. Of course, I mean, a genuine professional is tough to find. I mean, in today's market, that's another thing. So this is my advice on, like, this is the last part, and this is my advice from my side. Do not gamble with your hard earned money. If you want to go for direct stocks, learn. I mean, learn to earn. I mean, so study books, learn about companies, how to read their numbers and everything. Then only directly invest in stocks. Or if you're going for mutual funds, also do some research. It's not very tough. I mean, if you go just read some articles, watch some YouTube videos, you will be able to understand them. And also identify yourself into a particular category. In which category you are, you want to invest directly, you want to buy mutual funds, or you want to basically go for index funds. So identify this. Of course, increase your earning. That's quite important. I mean, if you want to make, of course, let's say if you are just putting 5,000 for 10 years, right? You're not increasing your allocation. Then of course your final money will be less. But if you keep on increasing, like like first year you are investing, starting with 5,000, next year 6,000, next year maybe 10,000, then of course your returns at last will be greater. So that's why increase your earning. And at last, of course, increase savings and investment. I told you in the richest man in Babylon, that book, increase savings and investment. So for this, what you should do is, of course, you have to work hard, increase your earning, keep saving more, and keep investing more. That's how you become rich in long term, not in short term. I mean, but of course, if you are there for like 20 years, I told you, right, that 10,000 investment in Nifty fund, Nifty index is worth around 12 lakhs. Sorry, it was how much? It was 1.2 lakhs, right? That is 12x times. Now, if you invest 1 lakh at this time, in next 24 years, you may expect the same. Now, this 1 lakh in next 12 years, it will be like, I mean, 12 lakhs, right? Let's say. And of course, you will keep on increasing this also, right? So if it's 10 crore, then it becomes 1 crore. I mean, sorry, 10 crores into 12, you have to multiply, right? So you get 1 crore, right? So you understand this, right? That's how you get rich in the long term. So that's what the simple advice I wanted to give you. This advice are very simple, but nobody follows this. I mean, because nobody has this much patience. I mean, like to wait for 10 years, 15 years. Everybody wants to make money in 1 year, 5 months, 6 months. So that's where most people, I will say, lose money in this stock market. So that's my general advice on like how to make money in stock market. If you did like my content here, please do not forget to press the subscribe button here and subscribe to my channel. Thank you.